All right. Okay, so everyone, my name is Nilesh. I'm the co-founder of Tradl AI. We are building an AI trading intelligence platform. We'll also give you a quick run through of how the platform works, what have we built, what are we building in future, and how does it marry with the concept and the theme of today's webinar. The idea is to sort of bridge the gap between institutional traders and retail traders with a quant approach, and that is what we are doing with the help of AI, and that's how we have come up with this brainchild Tradl AI. A quick introduction about myself. So I happen to be a graduate from IIT Guwahati, batch 2013 to 2017. Post that, I've had roughly about 8.5 years of experience by now. I've worked for a leading FMCG company called ITC. Then I worked in the startup ecosystem as a senior operator across three different spaces, three different startups. The last one where I was working before starting up Tradl AI was a fintech company called Stable Money, where I was heading the credit card business. A quick introduction about Anupreet. Before I start, I hope I have pinned Anupreet's video on everyone's screen. So just confirm by giving a thumbs up if you can see him. Okay, perfect, perfect. So Anupreet is actually our senior. So he is a graduate from same college, IIT Guwahati, 2015 pass out. He happens to be, a former lead analyst from 361 mutual fund. He was, leading a complete, the quant analytics team, which was responsible for managing the entire fund. He has roughly about 7 years of experience working in the quant domain, and then he started his own company called Beyond IRR, which is a B2B fintech company backed by Zerodha's Rainmatter arm. He's also starting up another platform called LevUp, which is going to come up with quant investing strategies for retail investors. And I think it's currently being built a few months away from now, but I would let Anupreet, just show a glimpse of LevUp also during his introduction. Over to you, Anupreet.
Yeah, hi, thank you. Thank you, Nilesh, for the nice introduction. So, hi guys, like Nilesh has already introduced, I have spent 7 years almost in, building all this investment strategies and quant systems. At Beyond IRR also, we have multiple businesses related to it, but mostly around fintech, which is basically a sort of a system which helps banks, wealth firms to manage their client portfolios, right? So it has a lot of all this quantitative analytics sort of things. On the LevUp side, what we are trying to do is take out that system which is already implemented in India's largest wealth firms and banks, and give it to the retail investors and affluents and HNIs, right? So that's where we are. On the LevUp side, we are awaiting SEBI licenses, because in order to advise someone, you need all those licenses. Once that is done, maybe in next 2-3 months, it will be live, and all these strategies, then you can directly invest through our platform. So I think, Nilesh, we can just start with the topic today, so that
Yes. Let's jump into the topic, and we'll keep interacting with the audience, during these slides. And whenever people would like to ask questions, just give a thumbs up or raise your hands using the emotions available on the Google Meet. And then we'll also reserve some amount of time, roughly about 10-15 minutes towards the end. I'll also give you a quick demo of Tradl AI, as well as we'll take up questions.
Sure.
Okay, we can start.
Yeah, thank you everyone. So that you have come at early morning on Saturday. It's very difficult to come so early. So let's make this session very fruitful to everyone. And I want to keep this session very interactive. So at any point of time, if you feel that, okay, this doesn't make sense, or I have any doubt around it, feel free to ask, like Nilesh has already mentioned. So let's start with the topic. So here, what I'm trying to do is, give you a
quick suggestion. ये जो आपका Google Meet का pop-up है ना, you can cross this. It will not close your call. It will just go in the background.
Okay, got it. Now screen is visible, right? You can see
my
presentation.
Visible.
Okay. So the idea of this presentation is to start with very basics, because in investing, I believe that simple thing works, and simple thing scales, right? So it's not necessary that only complex strategies will make you money. Simple things done at a scale and with a lot of discipline can still make you a lot of money. I'm not sure like how many people of you, how many people here are well averse with quant strategies. So I will just take that. Take a thing that I will start with very basics and then build up to a level where we can show you how institutions think. Like, at least like what I used to work at uh, previous quant mutual fund and what I'm building at level. The way we are building, we can get to that level starting from very basics, right? So my philosophy is that market can be thought of as a cake, right? So let's say imagine you are in a birthday party and there is a cake in front of you. You can think of slicing this cake in a different way, right? Some people might prefer more cream, some people might prefer cherry on top or something like that, right? So this same cake can be sliced into different ways. So let's say more cream or different size or different flavors, right? If it has a different sort of flavors. Similarly, market is also sort of a cake, right? Imagine there are like 5,000 companies listed, right? The way you decide the rules, you can cut this entire cake into different slices, and that slices will decide how much return you can make, right? So let's say if you cut the market uh, into a slice where the rules are you select the top 50 companies every 6 months based on their size, then eventually you are building a strategy which is also called as Nifty 50, right? I mean, the Nifty 50 has given 12-13% returns in a very long period, let's say 20 years of period. It's a good strategy, right? I mean, 12-13% return just by slicing this entire m- market sort of cake and just selecting top 50 companies, weighting them with market cap, you can achieve 12 to 13%. Nothing can be much simpler than this, right? There are other ways also, like you can select companies which seem cheap, and to decide cheapness, you can have different parameters, and then you can slice that market into that particular rule. Using that particular rule, that will be called as a value strategy, right? The value again is itself is a very famous sort of strategies, and a lot of people, investors, are famous for following these kind of strategies. So market is, imagine it's sort of cake, right? And as a quant guy or any investor as such, not only quantitative guy, your role is to find out a slice which works for you, right? So every slice will have certain pros and certain cons, right? Some slice will give you more cream than, but it will lack some other aspects. Similarly, let's say if I'm buying Nifty 50 based on this rule, it might see some sort of drawdowns at a certain period, right? It might not be optimized for certain conditions, but then in a long run, it might be optimized for, let's say, decent sort of returns. So if we take this analogy, right, of slicing a cake and try to put it into, let's say, a quant framework, then we have three things that any quantitative strategy should have, right? One is it has to be objective, should define its characteristics objectively. So in case of Nifty 50, let's say if it is a quant strategy, if we have to check whether it is a quant strategy or not, the objective is, it's very objective, right? All the characteristics are defined. So what are the characteristics here? We are taking market cap as the only parameter here, right? It's very objectively defined. Any given day, you can calculate the market capitalization of any listed company, right? Second, it has to be rule based. So again, if you take very simplistic quant strategies, which is Nifty 50, it has a rule that it will do this calculation every 6 months, sort, let's say, top 50 companies out of the entire universe, and buy those companies in a proportion of their market cap, right? So it's rule based, and the entire process is systematic, right? I mean, there is no human intervention. You don't need any human eye to buy these 50 companies, right? So if these three rules are satisfied, then it is a quant strategy. Now I've taken a Nifty 50 as an example because everyone here might be aware of Nifty 50, but it could be as complex as, let's say, you're building some sophisticated machine learning based quant strategy, but ultimately it will follow these three rules, right? If it is not systematic, there is some human intervention, then by definition, at least what I use, it will not be called as quant strategy, right? Quant has to be fully systematic, rule based, and objective. Okay. And if you take this three rules and try to apply, then you can figure out there are different sort of quant strategies, right? So typically the rules can be either quantifying on the mean reversion. So they will be betting whether something has moved off the mean and it will come back to the mean. So those kind of strategies are called mean reversion. Some strategies would be betting on trend. So Nifty 50 is sort of a trend following strategy, because what it does is it is picking the largest companies, right? And these largest companies keep on changing. So some new names will come, some new, older names will go out. So it is sort of a trend following, or it could be an arbitrage. So these are the three broad categories where all the strategies will fall into, right? Arbitrage is something where there you see some sort of inefficiency which should not be there, and you just immediately captured it, and you keep on capturing it, and you make a small percentage of returns, right? And these are the three broad categories, and within that you will find different sort of ways of capturing these strategies. For example, there is a very famous way which we'll talk today, is called factor investing. Factor investing is a quant strategy where we try to find out different sort of factors which gives returns, right? We'll explain more in the coming slides. But this is one such category, and then we already know HFT, MFT, LFTs, all these high frequency, medium frequency strategies. Then there are event driven startup and many more strategies which I have not described yet. But if you see the entire quant space, this is it, right? I mean, these are the rules: objective, rule based, systematic, and ultimately these are the categories. So every strategy will fall somewhere in this entire universe. Okay. So here is a very we have to build strategies, right? I mean, assuming, let's say, we don't have any knowledge of building any quant based system, then how to think about it, right? So the first question that should come into your mind is like, how strategies make returns, right? What is a return, right? So to think about it, there is a thought experiment that so let's say you invested 100 rupees in Nifty 50 vis-a-vis, let's say, Nifty small cap 250, right? These are two indexes. Again, it follows our rule of systematic, quant, objective and quant driven rules. So let's say if you invest in Nifty 50 and you have invested the same amount in Nifty small cap 250, right? Over a long term, let's say I have taken only 5-year return here. What will happen is that what has happened in the past, that small cap will give you more returns, right? We have already seen this, but small cap also come with risk, right? So the question here is that why this return is there? Why do you think that small cap should, in the long run outperform, let's say, large caps? If people can think about it and tell. I've already written here like why this happens. But the idea here is that you need to understand certain risk factors, right? So small cap companies are risky. They are risky because they are small. And because they are small, they offer a substantial growth potential, which can give you higher returns, right? So if you're taking risk at certain point of time, you should be rewarded with some kind of return, right? That's the whole concept of investing. Hence, in the long term, if you systematically do this, keep on buying small companies with certain rules, you will end up with higher returns than, let's say, large cap. And this entire thing is called as a size factor. Okay. That's why people say if you invest in small cap, you will have much more drawdowns, much more risk attached to it. But in the long term, maybe you will get more returns than large cap, right? That's the whole point of investing. So if you're carrying risk, in the long term, what will happen, that will be rewarded with some sort of return. And that's where the entire process of quant investing or finding alphas lies into. Because what you have to do is figure out some sort of a systematic risk and take exposure to it and wait for the returns to come into picture. So this is how the evolution of portfolio returns has evolved. Like in 1960s, people used to believe that if you buy certain set of companies, it will give you a return, and it is entire portfolio return. But in 1980s, they figure out that some part of it's actually driven by market, which is very systematic, and that's where models like CAPM has come, which is capital asset pricing model, and rest of the things were alpha. This was the belief till 1980s, and then people figure out that alpha itself is made up of different factors like momentum, value, size, and all those stuff, and the alpha is shrinking, right? So the understanding of how portfolio make returns has evolved over time, and now people believe that there are lot of factors which, if you systematically build that into your portfolio, you will still get returns on top of market returns. And alpha is something which is very specific to how you pick stocks. So the alpha is shrinking, and now it is to an extent that if you check the Indian mutual funds, alpha for a lot of funds is almost zero or negative, right? Most of the returns are either through market or through exposure, systematic exposure to different factors. Okay. So so far, if anyone has questions, they can ask. Like, I'm not sure like whether you are getting it or not, but
Yes, everyone, please let us know if the pace is fine, if you want us to, take it slightly slow or, make it
yeah, I
little
mean,
fast.
you can be very interactive. See, all these things are I'm not sure like how many of you might know or might not know, but this is something, it's not easy to grasp for the first time if you're listening it. But if you're already aware, then it would look very easy. Yeah,
Yeah, we do have some experienced folks also on the group because I know
yeah,
them
yeah. Yeah.
personally. But yeah, let's keep it more beginner friendly. We can resume on the slides, Anupreet. We'll take up questions later and then engage with the audience as well.
Yeah.
Sunil has
So
a question. If you want, I can take it up right now. Sunil is asking if we can identify the trend reversal at the correct time, then alpha can be optimized.
yeah, so I will come on the timing aspect, like how we do it. But so far, let me summarize what I'm telling you. There are different ways to capture returns in the market. It's as good as slicing a cake. So you can slice the market and take positions and make returns, right? So what are the ways? It could be either quantitative or it could be very discretionary in nature. Since the session is about quant strategies, so we are focused on quant. Now, quant is, like I said, there are three ways to do it. Three important things that it has to follow. One, it has to be systematic, rule driven, and it has to be objective, right? That is what how the quant is defined. In quant, there are different ways. We are focused on factors. And what are factors? Factors are nothing but risk buckets where we take exposure, knowing the risk, and we wait till we get the reward. Right? That's how factor investing is defined. So if you are betting on small caps, you're taking the risk, so you will see some drawdowns, but in the long term, you expect that you will get higher returns, let's say more than large caps, right? Higher than large caps. So that's what factor is. Now, size is one way to slice the market. There are 100 different ways to slice the market, and we'll discover that how to figure out that. And also timing. So timing we'll discuss. It is much more complex
One
way.
small question also, Anupreet. Anmol is asking, can you explain alpha a bit more? Just a quick
Okay,
explanation.
so yeah, so alpha is, what is alpha? Let's say fund manager is investing in let's say 20 stocks, 30 stocks. There's a mutual fund manager. So let's say in a long run, they gave 15% return, 1.5. Okay. And then if you see the fact sheet, right, every month there is a fact sheet which is published by a mutual fund. They will also show you the benchmark returns. So let's say they decided the benchmark would be Nifty 500, right? It's a NSE 500 is a benchmark they have chosen. And let's say the benchmark has given 12%, okay, in the same period. So 15% of fund manager returns versus 12%. So you would see, okay, 3% was the outperformance, right? Now this 3% is an outperformance. So earlier, if let's say in 1960s, if this was the case of 1960s where this fact sheet was published, then fund manager would say, okay, I have given 3%, return, right? But in 1980, what will happen is that they will say ki, alpha is 3%, market return is 12%, right? So total 3 plus 12 is 50. In 1960s, there was no, demarcation. Like, I mean, 15 is 15. Like, portfolio has given whatever magic they have used, they have given 15% return. But in 1980s, people started asking questions. They said ki market has given 12%. You have given just 3% on top of the market, right? So they said alpha is 3%. But then a lot of people did research and said ki it is not alpha, right? I mean, alpha is basically anything which can't be explained in a very simple term. So I can explain that market has given 12%. So if you only take market, you would have got 12%, right? But you got 15. So you have done something in the background which has given this outperformance. And in 1980s, people were not able to explain what you have done, right? It could be anything, but they were not able to explain. So they called it as alpha, right? 3% as alpha. But as the time progressed, they came up with a lot of explanatory variables, which are called as factors. So they said, okay, market gave 15. Let's say you were exposed to momentum factor and momentum gave another 2%. So 15 plus 2 is now, sorry, 13 plus, sorry, 12 plus 2 is 14%, and total return was 15. So alpha is now 1, right? So 1 is now something which I can't explain, but I can explain the other 14% return, right? So imagine alpha is something which is the skill set of a fund manager, which can't be explained with systematic or any factors attributed to the portfolio. So let's say whatever returns you give, and I can do some sort of analysis and figure out, okay, this much returns I can explain why it came, because you bought certain securities and all. But the rest of the part I am not able to explain. The rest of the part is something we call as alpha, right? So over time you are seeing that people are coming with different sort of factors, which is trying to shrink that alpha, right? So basically क्या हो रहा है कि fund manager का जो skill set है, that is now shrinking over time. Fund manager is thinking, yeah, this is my skill set, but it is not. It is basically taking exposure to certain factors. So example देता हूँ. Let's say if a fund manager takes only small caps, right? And in 1960s you are sitting, so you will say कि 17% return आ गया, right? But over time you will say a return was not due to your skill set. It was because you took small cap companies, and in the long term you were rewarded. So it is not your skill set. It is just as good as picking some small cap index. I hope I answered your question. So this part is now shrinking over time, right? So we are focused on this part, factor return. Market return is very simple. Like, I mean, buy any market index and you will get certain returns. On top of it, you can add, let's say, take some factor exposure. And then alpha is something which is very specific to the skill set of a fund manager. Okay. So let's move on. So to understand factors much better, I have this analogy, right? To get a blockbuster movie, right, you need a star cast, you need story and direction, cinematography, promotion, visual effects, lot of things, right? And you combine all those things and you get a blockbuster movie, right? Similarly, to get a robust portfolio, right, you need a lot of factors. So for example, like I was saying, momentum, right? So that could be classified as price increase, right? Different fundamental factors. Let's say you are picking quality companies, or maybe value related factors. You are picking cheap companies. So if you combine all those things, right, you can get a robust portfolio. And again, the timing would be again a factor in it. So there would be a time where every company would seem expensive. So you can reduce exposure and you can bet on, let's say, momentum as a factor, right? So timing also itself can make your portfolio very robust. But this is the analogy, right? I mean, factors are basically just like a movie has to be, if it has to be blockbuster, then these are the factors responsible for that. Similarly, a portfolio, if it has to be robust, then these are the factors, right? So for every factor there is some sort of portfolio you can build, and you can explain returns if the portfolio is given, let's say X% of returns, and out of X, how many percentage of how much percentage of returns has come from these factors, right? So let's build a very simple algorithm. If we go through this process, we will understand like what are factors and how to implement it. So let's start with the top 500 companies, right? By market capitalization. So any given day, you go all the listed companies, you take out a list, calculate the market cap on that day, and at the end of the day, and sort it and select the top 500 companies. This is your universe, right? For each of these companies, let's say you calculate 6-month and 12-month returns. So what you have to do is you go back 6 months, you go back 12 months, you calculate the returns. You also calculate the daily return standard deviation. Okay. So for that 12 months and 6 months, you have, let's say, whatever, like 252 data points for 12 months. You can calculate the standard deviation of that distribution, right? So you have 500 data points, right, for each of these values, companies. Then you have to calculate the score. So this score is basically average of 6-month and 12-month risk adjusted returns. Basically, you divide returns by risk. And once you have this score, right, there would be 500 data points. You sort it again, basis highest score comes at top. And once you have sorted it, then you select the top 50 companies, and let's say you give them equal weight. You don't have to do some fancy stuff. Every company will get 2% of weightage, and you do this exercise every 6 months. Yeah, it's very simple investment algorithm. Then what would happen that you would have outperformed almost all leading funds in the country, right? So this strategy, if you do this simple thing, would have delivered 18% of return compared to 15% average of all these mutual funds. So blue one is your strategy, and other funds are just average. I've taken the flexi cap as the universe for comparing this. So what we have done is we have built a very basic momentum strategy, right? It's long only momentum strategy. And as you can see, it has outperformed a lot of mutual funds. It also has some sort of drawdowns. As you can see, like year it has fallen, year also it has fallen in 2020. Some sort of you can see some drawdowns here and there. But this is the entire strategy, right? I mean, it's very simple way of building a strategy. And momentum is one such factor, right? So there are different ways of building it. So instead of let's say taking the price and returns, I can take some fancy stuff. So I can also improve this. Let's say instead of 6 months, 12 months, I will take 3 months, 6 months, 12 months, and see what are the results, right? I can also change the weightages. Instead of doing equal weight, I can do weights which maximizes the score. Okay. So I mean, there are n number of combinations, and you can build n number of strategies and figure out what is the best suited for you, right? So like I said, momentum factor, there are other factors also. Let's say there would be a value factor, there would be a quality factor. So instead of calculating returns, you will be calculating price to earnings ratio, price to book ratios. For quality would be ROE and other factors, right? So you can use and you can calculate some sort of score, like I've said here. And again, do the same exercise, sort it, select the top of 50 or 30, whatever companies you want, and then figure out whether this strategy works or not, right? So this is the most simplistic way of building a long only factor based portfolio, and a very robust portfolio, right? I mean, you don't have to even look at it for, let's say, 6 months. Every 6 months you can do this. It might hardly take any time, and it will give you decent enough returns to beat a lot of mutual funds and all, right? So our focus right now, because I can't cover all these strategies. In fact, I mean, if you talk about factor investing, there are thousands of factors, right? Every now and then people come with some factor, right? So it's like a zoo where you're not say you can see a lot of factors, like you see a lot of animals in a zoo. So we call it as a factor zoo, but a lot of factors are not that important. Maybe they are just combination of existing factors. But if you talk about common factor, it is momentum, value, quality, low volatility, and carry, where dividend yield and all, you can use that as a factor and build portfolios, right? So we'll be focusing on momentum factor right now because again, it's one of the most simplistic and doesn't need a lot of data points. It can only work on, let's say, price, right? Price and maybe some sort of volume as two parameters, right? So momentum factor is basically it exploits the tendency of winning stocks to continue performing well in the near term. If you remember my previous slide, right, I was classifying quant strategies into three buckets: mean reverting, trend following, and arbitrage. Momentum comes into trend following bucket, right? So it is basically betting on stocks which are already working, right? So they have given decent run, let's say 3 months, 6 months returns they have already given, and now you are entering and thinking that they will continue that bull run, right? So it is very counterintuitive, right? I mean, we have already been taught that don't invest in something which has already worked in the past, right? But momentum is exactly opposite to that. Why it works is because of a behavioral factor that people usually underreact or overreact to certain stocks. So let's say if something is working, their fundamentals might be changing, the company fundamentals might be improving, right? And then people discount that factor. They see that it is temporary, it will not improve to its full potential, and they will buy that stock in tranches. And because of that flow is coming in tranches, if you enter at the right time, you can take advantage of it, right? And momentum is the factor which has worked almost in every asset across the globe. Okay, so it is not a very India specific story. It has worked in US, it has worked in equity, debt, commodities, almost every asset that you can think of. And it has worked for more than 200 years. So all the research that you can find on momentum, it is very thorough research, right? So it is not a new thing that we are discussing here. And that's why momentum is one of the most promising factor in any investing investing related thing you will read, right? But because it is most promising, it is betting on stocks which are already winning. It also has risk, so it has the highest drawdown also, right, as compared to other factors. So it might give you a drawdown as worst as, let's say, 60-70%. Like it has already, we have tested this in Indian markets. So situation like, let's say, subprime crisis and all, it can take your portfolio down by 60-70%, right? And that's where you need to implement some other uh, factors or maybe other ways of controlling your risk. You can't just take a naked exposure to any factor. It's just like if you do FNO investing, just putting buying put or selling a call is not a right strategy, right? I mean, naked exposure is not a good thing. So similarly, in momentum, naked exposure to a factor is not a good thing. You have to, you should have a way to control different risks in your portfolio, and we will be discussing that in coming few slides. So I have already discussed this in my previous slide. You need certain descriptors. For momentum, it is price. You need certain rules. For momentum, it is 6-month, 12-month returns, risk-adjusted returns, and you need a rebalance, which we are doing 6 months. Every 6 months, we are calculating it and buying that portfolio, right? This is very simplistic, right? Right now, I have discussed the very building blocks, right? But when we do it for institutions, when we are managing someone else's money, right, we are acting as a fiduciary. In that case, we need certain sort of systems so that things don't go wrong, right? So there is a thing, right? I mean, if I have to bet my own money, it I might take an amount of risk, right? But if I'm managing someone else's money, I have to make the strategy very investable, right? So if it is seeing a lot of drawdowns, if it is seeing long periods of underperformance, then the strategy is not investable. It might suit me because I, at a personal capacity, I might take a risk. But when I'm investing someone else's money, it is not the case, right? Because I'm also competing with other fund managers. So that's where the institutional system comes into play. And the major objective of that system is to control risk. Return is secondary objective. First is to control risk so that people money is in safe hands, right? So this is how a typical system would look for factor investing in any institutional quant firm. So you will have certain uh, database where you will be fetching or storing all the company fundamentals, stock prices and volumes, and other data also which are required to build strategies. Then you will have certain sort of filters, right? So in the previous example, we have a filter of selecting top 500 companies basis market cap. But in real life, let's say if you have to, build a strategy that can work, let's say for 5,000 crores of asset, then we need other filters also, like what is the liquidity, how much trading is happening every day. Because if that is not considered, then what will happen? We will stuck with a portfolio which we are not able to sell quickly, right? So all those filters are in place to, filter out the universe, and then you get something called as investable universe. On this universe, then you run different sort of scoring met so scoring formulas. Like in case of momentum, we are taking 6 months, 12 months, so you can define your own formulas. And you also have something called as regime, where the timing piece will come, like how to enter, how much risk you should take depending on where the market is, right? So this regime model will tell you how much position you should take and what kind of risk controls you will have. And then you will build a portfolio which will rebalance and feed in the data to all these databases. And again, the whole process will continue, right? So this is a typical, very broad level architecture of any institutional quant firm, right? This is how the system will be built. Uh, I can walk you through one of the strategies that we used to run. And again, this is a momentum strategies because I am talking about momentum only. So, so we used to take NSE 500 as a universe. There was no gap up or gap downs in last 90 days. So if any gap up or gap downs has happened, let's say more than 10% or 15%, we will exclude that from the universe. All data are in time, like point in time. We can't have survivorship bias or lookout bias, nothing of that sort. Okay. For signals, what we used to do, like typical momentum, you start with that, let's say 12 months, 6 months, 3 months returns. And then you use combination of period. And then instead of, taking the raw returns as a score, we will take it a risk adjusted basis. So there is something called as frog in the pan. You can also use standard deviation, but we used to use frog in the pan. Basically, it used to calculate for last 250 days how many days were uh, advances versus, like, how many days it was positive versus negative, and then we used to calculate a score. And if that score is good, then we will take that stock. Otherwise, we will penalize, right? And then once you have this, then you standardize this score. So we use something called as Z score. So Z score also, there are two ways. One is min max. Second is based on mean and standard deviation. So this is cross sectional Z score based on mean and standard deviation. And then we used to residualize all the unwanted factor exposures. So like I said, imagine market as a cake. So even if you're cutting a cake and hoping that you will get the cream, you still get, the other parts, right? I mean, so you have to remove. If you only want cream, then you have to slice that off. So that process is called as residualization. Again, on weighting also, we had different risk-based weighting optimizers, and also, sector constraints. So because we are, doing this for a larger uh, AUM size, right? Thousands of crores. then we have to have certain sector constraints. We can't take heavily bet on a sector, and then if it turns around, then risk will increase, right? So we used to have, let's say, we will not go beyond, let's say, 10% of the sector exposure as compared to the benchmark. So let's say benchmark has 30% of financials. So we can go max to max 40 or min to min 20. So this is the range, right? So once you have that range, then you have to maximize your factor exposure and build a portfolio around it. On regime side, we also have something called as binary regime checks, where threshold models like 200 DMA, 100 DMA. So basically, you take a broad-based index, you calculate whether uh, it is above the moving average or below the moving average. You can decide which regime it is, bullish or bearish. It's a very basic model. Or you can have a HMM based model or something very complex, maybe volatility based targeting, right? Those kind of sort of things, right? And then you have stop losses. So even if you take exposure, or let's say 50 companies, for each of the companies you have defined regime dependent stop losses. So let's say if the stock goes below 100 DMA, I will sell it, or it ranks fall below 50, I will sell it. Those kind of stuff, right? So this is like how a typical strategy would look, right? I mean, if you dig deeper, then complexity will increase. But idea is even if you do the basics, the returns that you will generate will not be so different from what institutions use, right? Institutions mostly are focused on scale because they want to manage, let's say, thousands of crores, so they have to do all this. But at a retail level, you can just check for returns and the risk, and it would be good enough to go, right? So this is how you calculate momentum signals, like I was saying in the previous slide. 12
Anup,
month signal,
I have a
6.
couple of questions if we can take very quick questions.
Yeah.
Sunil is asking which set of factors you value more. Do you value fundamentals more or statistical factors more? More? And what if both of them are classic in certain scenarios?
See, so it depends on the strategy, right? I mean, let's say if I'm building a momentum strategy and I'm telling my investors that this is a momentum strategy and it has all the risk attached to a momentum strategy, then it will be only based on factors like, let's say, price and returns, right? From price, you can calculate returns and other stuff, right? All the statistical or technical factors, like you're saying, right? But if you are building a multi-factor strategy where you are also, taking, let's say, fundamentals into account, then the strategy will consider that, right? So idea from an institutional perspective, it has to be very clear that what I am trying to build. Okay. I can't have a, black box and say I will do something. You don't forget. Do you forget about what I am doing? You just invest money. That is not a right approach. I mean, because I am managing your money, I should tell you what kind of risk I am taking, and when this strategy will do well, when it will not do well, right? So if I'm saying momentum, this is a momentum strategy, I will clearly say it will not do well in the market, like when it is sideways or when it is falling, right? Because it's a long only momentum strategy, and you should be aware of that risk, right? If I'm saying this is a multi-factor and we will try to time the different factors. Let's say it will take fundamentals also, it will take price also, and it will try to optimize on timing. Whatever is working, it will take that exposure, and it is a sort of all-weather strategy. Then the risk reward changes, right? So it is not a clear, plain answer that what I take. It is about how I am designing the strategy, right? So I hope this answers your question.
Yeah, just one more question and then we'll move next. Sunil is again asking, low volatility is good for returns equity curve, but low volatility may not be favorable for the instruments we have invested in, if our direction is correct. Any thoughts on this?
Okay, so low volatility as a factor, right? I mean, is basically taking bets on stocks which has low volatility, means low standard deviation or something of that sort, right? So if low volatility is working, it means that other factors might not work, which has a very low correlation with low volatility. So, for example, whenever low vol works, right, momentum will not work. Okay. So I'm not sure if I get your question correct, but point is, let's say if I have to build a strategy which is taking bet both on momentum as well low wall, what I will do, I will have certain regime in mind. Okay, so I will say, ki, okay, if I can identify market as bullish, maybe let's say I take a very simplistic model. So I will take Nifty 500 as the index, and I will take 200 daily moving average as the indicator. So whenever the Nifty 500 crosses Nifty 200 DMA, I will say this is a bullish regime, and whenever it is bullish, I will expose myself to momentum factor. Okay, and whenever opposite happens, I will switch to low wall factor, right? Timing might not be perfect because see, moving averages are delayed by nature, right? So it might be delayed by certain, certain weeks, right? A number of weeks, right? So, but in the long term, I will contain the risk and maybe I will get some returns. So this is how you think, right? I mean, you can't have just one slice of a cake uh, uh, and uh, and believe that it will give you returns every period, right? I mean, in the long term, every single factor will give you return. That's why it's called factor, because you're taking risk, and maybe after 20 years, every factor has to give returns, right? Because it was designed in such a way. But in the short term, you will see certain ups and downs. Some factor will do well, some will not do well. And if your timing is good enough, which is extremely difficult to do, then you can, reduce the volatility or maybe increase the returns.
All
Yeah.
right, I think that answers Sunil's question. There are a few more questions, and Sunil might want to also engage, but we'll just do that after covering the last few slides. We are left with three or four
So
more.
there is, yeah, I mean, these are the signals you can get deep into it. I'm not getting into technicals. Basically, we try to residualize and, run this regression for each stock. Uh, anyway, so these are the results. You can see the returns and all. Now backtest, these are backtesting results, right? I mean, backtesting is never to claim that strategy is working. Backtesting, in my belief, is only for you to understand the risk, right? So if I can go through and check all the backtesting results, I can get some sort of comfort. Results might be very different, right? I mean, it might not even give, let's say, 20% of return, 20%, right? But if I know this strategy works in different conditions, I have stress tested it, I have some confidence, right? You can't be very sure about the future. So backtesting is something gives you that confidence. Okay, I can expose some part of my portfolio so to these kind of strategies, and continue monitoring it, right? I mean, over time it might give returns, right? Because it has given return in the past. So this is it. This was my last slide. Uh, so we can have now Q&A.
Yeah. Anyone? I think Parth has a question on the chat. Can you please explain this low volatility strategy very briefly in one or two lines?
Okay, so low wall is basically so in momentum you are taking 12 month, 6 month returns, right? And dividing it by standard deviation, right? In low wall, what you can do is you can just take the standard deviation of all the stocks. Let's say for 1 year you calculate daily returns and take the standard deviation of those returns. So you will get standard deviation for all the stocks, है ना? 500 stocks or 500 values. Now sorted, the lowest should come first. So lowest risk is the highest priority. Sort it like that. And let's say select top 30 companies. That's what low wall is in a very basic terms. So you are taking exposure to stocks which are less volatile, let's say in past 1 year. Okay, so just to wrap it up, right? I mean, as you can see that the entire process of building a quant strategy, it evolves around testing different hypotheses, uh, and it is a very repetitive process. It is not easy to do it without a system. And when Nilesh came to me with all this AI based system, I was very excited to see that you can just write it in a natural language and the system will give you some outputs, right? So And like there are other systems also AI, but what Nilesh and team are doing is that they are focusing more on the calculation side, right? They are making sure that all the calculations that you are doing in calculating all these scores are correct, right? So you can come up with different thought process. You can change the parameters, and it will run in the background and it will give you the results. So the time to do research reduces, right? So that's where the quant, the edge lies, right? Because in quant, what happens in as a, like, if I am a quant fund manager, the biggest fear for me is that whatever rules I have built, right, the edge will go away because lot and lot of people will know about it and they will try to exploit it. Because of this, crowding will be there on those factors. So I have to figure out new ways of, finding the inefficiencies in the market. And it's a very tedious process because you have to read new stuff, you have to build the strategies, you have to keep on testing. And that's where I think systems like Tradl would help. And it requires time, right? I mean, even if you're doing on Tradl, it requires time to think and do it. If you have time, good enough, right? If you don't have time, then you should trust someone, some fund manager who can, take your money and manage it. So that's what we are doing at LevUp. So we are building all this fundamental strategies as a building blocks. And when you come as an investor, you have the right to choose, right? You can understand every strategy in depth, and we will implement it for you. Yeah.
Right. So, Anupreet, I think there's just one last question. We'll quickly cover that, and then I'll probably take up for the demo. Snehal is asking, mean reversion for already moved stocks is ideally a selling strategy, hoping the price reaches its mean. How institutions leverage this, either through selling futures or something else? If yes, then do they hedge their positions, or do they do some other risk management strategy?
Okay, so see, if you are if you're believing that some stock has already moved up and it will revert to its mean, and you're building on that strategy, what you can do is you can short that, right? I mean, short that strategy. Ideally, momentum is opposite of it, right? So so momentum takes all those stocks which has already moved up. So it longs on those stocks, like it takes long position, and it shorts all those stocks which has gone down, right? That's a momentum in a very fundamental way, right? But when you're saying anything which has moved up, I will short it, right? It's not a momentum strategy. It could be something, you can name it to, let's say, some X factor. But in order to do so, institutions, what they do, they will short it, right? In mutual fund case, shorting is like naked shorting is not allowed. You need a long exposure also, like in cash segment. So if you are shorting, let's say, a future of a stock, you also need a similar exposure in cash. So Reliance का 100 stocks है, so I can short Reliance future, right? It is not allowed कि I will only short Reliance future and I will not take any exposure in the cash segment, right? So that is not allowed in the mutual fund space. In prop trading firms, you are allowed to do anything. Again, depends on how what is the depth in the market. But if you are considering, let's say, mean reversion as a strategy, value investing is something which is totally based on that, right? So just looking at something has moved up and I will short it, you should also you should also add a valuation as a factor. So something has moved up in terms of valuation and it has gone to a high where it doesn't justify its valuation, then I will short it. So it is much more, it's a much better way as compared to just considering only price, right? So you just divided price by valuation and you can short it and it might make money, right, in the long term.
All right. Thank you, Anupreet. I think that answers it. Snehal also acknowledged the same. Now, let me just give a quick demo of Tradl AI to everyone who has joined. And, okay, Samarth has raised his hand. Samarth, do you want to unmute yourself? Because I don't see your question on the chat. So if you want to
Yep.
unmute, and please go ahead.
Hi, everyone. Good morning. I
Yes.
have my own few questions, but before that, let me continue on the previous one that Snehal asked.
Yeah.
Actually, I wanted to ask how often the quant traders they short on equity stocks, because it is on options or futures. If you do Nifty or something, then mean reversion is we see mean reversion happening quite often on shorter time frame, but on equities I've seen that it goes sideways. It is more like time correction and then the mean reversion happen there. So if you are shorting on if there is already some momentum, and another question that comes with this is, when you make some position, do you already have a target price, and how you think that, okay, from this target it can still move up, or this is your zone of shorting right now. So you cannot just say, okay, I booked my target, now I will short it right then and there and will go towards the mean reversion and make money both ways. So how do you decide? And also, is it all the process, is it computer fed, or is it also intuition with computer fed? And if it is intuition, who takes the call?
Okay, got it. So I think first question was around like how often people do it, right? Shorting and all, right? This was the question.
Yeah, in the cash, in the equity market.
In the cash segment.
Yeah.
So in the cash segment, volume is not there, right? I mean, to short it. So what you people usually do is they get into future FNO segment, right? Because I'm talking about the institutions, because they
Yeah.
have a lot of money to do all this stuff. So cash is, I think, future FNO is, if I'm not wrong, much more. In terms of volume, it is like X times that of cash segment. So it makes sense to do it this in FNO segment. Uh, what I have discussed so far is only long only factor based strategies, right? I have not discussed anything which is shorting or taking anything on a FNO side. Usually in India, factors are mostly long only because the market lacks the depth, right? So if you are taking 500 stocks, right, out of those 500, 250 stocks are not in FNO segment. Even if I have to build, let's say, long short factor based strategy in India, it is not possible, right? Because the market is not aligned that, right? So anybody who is doing factor based would mostly will be doing long only or taking cash calls whenever the market is not in their favor. Okay, so these are the strategies. But when you talk about other, which I have not discussed in this presentation, let's say you are dealing with let's say you are taking positions in FNO segment, right? I mean, you are let's say doing ratios or spreads or those kind of strategy, right? So there, a lot of action is there. It's a different game altogether. It falls under MFT, something called as medium.
Even in the equity, when you like you showed the momentum strategy, let's talk just about the equity. How do you
So
decide, like, okay, this is
yeah, in equity, it is very simple. Like it's very vanilla in that sense. You just buy. If you don't feel that this factor will work, then you take a cash call. Okay. Now the second question is whether if you're buying on trend and then you are selling on reversion, like combining those things and everything is systematic. Uh, in my experience and all the quants that I've talked to, mixing everything in one strategy doesn't make sense, right? Because something will go wrong because timing, either you will not be able to time it perfectly, you will be late to the party, right? Or returns will not be optimized. So what usually people do, or even in the bigger quant firms, what they have is something called as pod structure. So they have small pods. So let's say Samarth comes and he's very good at momentum. So I'll give some money to Samarth. And let's say somebody is good at mean reversion studies, I'll give money to mean reversion, right? And that's how the allocation works. So you make money or they make money, whatever you're doing. If you're not making money, I will fire you. That's a very simple way of doing it. So even if you take that structure and you implement to your portfolio, what you should do is you should have different strategies and you should allocate money to each of these strategies. So some strategy will work in certain regime, other will not work, right? If you mix everything, you will not know what is the cause of the return, right? Because if let's say 10% return came, right, you will not be able to identify whether it came because of trend following or because of mean reversion, right? If you separate it out and then allocate, then you can still figure out, right? So I hope that answered your question.
just one last thing. How do you decide, like, now the target has achieved? Like, how do you
On the
sell?
target side, usually, so there are two ways to it. I mean, I personally believe, I do not believe in target prices because, I mean, let's say if I set a target price and stock moves above it, then I lost that opportunity, right? what I usually do is I believe in stop losses. Okay. So if something
Okay.
is not working, I will cut the losses. If something is working, I keep on holding, right? So let's say how do I decide whether I should keep on holding? Let's say simple things like if it is above moving average, if it is still under, let's say, top 50 ranks of momentum, right? There could be a number of factors that you can define, right? So if it is following all this, keep on holding. If any of these rules, if it is not, if it has stopped falling, you just sell it and take exposure to another stock, right? But there are people who also believe in target pricing. So what they do, they will book some profit and then break even on their investment, and the rest of the things they will keep live.
There are
I
some people
feel
you are
that is
saying some quant traders.
unnecessary over optimization, at least in the factor investing. You just need to. You were asking one more question, right?
For
Samaj,
some
can you,
people you are
Samaj, just excuse me. Can you park the question? We'll just come back to the Q&A again because there are a lot of people
Okay.
who are waiting for the demo. I'll
Yeah, yeah.
probably do that first, and people who want to ask questions, they can, stay with us, and Anupreet can also, probably give us 10 more minutes, and
Yeah.
then we will cover the rest of the remaining questions.
okay.
Okay?
Perfect. Perfect.
Okay, thank you. So I'll just quickly share my screen. Just let me know if you guys are able to see it now. Yeah, is it visible? All right. So first things first, as a part of the session, whoever has joined, we already had asked Anupreet to share a few strategies that he has been using in his quant, investing journey. So he's given us a few strategies. So we will be sharing this strategy note with everyone, which describes what the strategy is. We have also ran these strategies on Tradl AI, which I'm just going to show now, and you will be able to, you make a use of this particular note, get a deep dive into, how the strategy works, what's the understanding behind it, and how do you actually execute it on an AI screening platform like Tradl. So that is one thing. Apart from that, we'll also give you this interactive, toolkit where you can actually deep dive into all the technical indicators, which are going to be a part of those strategies that, Anupreet has been recommending. And you can do a deep dive in each of these strategy in terms of, how you can convert the strategy understanding into a natural language prompt, okay, for each of those strategies. So first you can understand what the strategy means, what's the logic behind it, what are the indicators being used. Then you can convert the strategy using a natural language prompt. And this is the beauty of Tradl AI. This is what we have built as a core competency of our platform. The idea is that, on Tradl AI, any user who is looking towards, understanding quant, testing quant thinking, can just come up and, write prompts in English, natural language, and in your own way. Okay. So this is more structured way of writing it. You can write many, in your own layman sense as well. And the platform will be able to make a sense out of it. What it essentially does is, after you write the prompt, it actually generates a code, runs it live on market data and on the stock universe that you select, and gives you the result. And you will be able to make sense of, how the strategy is getting converted into a final number or a final shortlist of stocks that you can actually, connect with the strategy that you initially thought of. So we have covered 4 strategies provided by Anupreet as a part of today's webinar. So we'll be providing, a detailed overview of this. Now let me show you how you can do this on Tradl. So this is our website called Tradl.in, the platform. You can go to Tradl.in. We are currently in beta phase, so it's currently being built with a lot of new upcoming features. What we have built so far is something that I'm going to cover right now. So the moment you sign up, our team is going to give you access, because we are currently rolling out access in a controlled manner. Once you are logged in, you have the access. You will see this particular, login screen where there is a chat interface, how you see on other LLM platforms like GPT, Perplexity, and so on. There are going to be multiple tools that Tradl AI is going to bring. We have rolled out currently 2 tools. One is stock screening and earning reports. Stock screening is to, write certain prompts or, write certain thoughts. It can be rule-based. It can be, as generic as possible. It can also demand certain complex calculations that you might want the platform to do, and it will be able to handle all of that. Okay. Earnings report is more of a qualitative analysis with the help of AI. So you can go into any company, get the con call reports, transcripts, annual presentations, quarterly reports, and just do a deep dive, keep asking questions using Tradl AI, and it will give you, any qualitative or quantitative insight that you want to generate out of those reports. Currently, as we speak, we have covered all the Nifty 50 stocks. We'll be expanding the coverage under the earnings report. On the stock screening side, we have all the NSE indices covered. So this is the tab for selecting your universe. You can select all, or you can select Nifty 50, Nifty 500, depending upon which universe you want to run your strategies on. These are some floating prompts to give you a sense of, what kind of screens you can create using natural prompts. You can simply select this and hit enter and see how it works. Before I do any live question, I'll just show you a glimpse of, how Anupreet's strategy were, created using, Tradl AI, and how we have ran it. So based on the first strategy Anupreet gave was, let's say, I'll pick this, probably this one, risk adjusted momentum. So on risk adjusted momentum, if we see, this is going to be probably here. Yeah. So risk adjusted momentum, you can define based on the strategy. You can write these metrics to be computed. You can simply put it down in the chat prompt box right here, and then you can hit enter. For example, I'll just do this live for you and keep showing the results here. Once you do this, you actually get to see how Tradl works. So the moment the prompt is written and you start processing it, it first creates an execution plan. It basically breaks down your prompt into a mathematical plan. It tells, okay, to answer your expected question, I need to perform these certain calculations. And in order to do these calculations, it basically first writes up a code automatically, then basically process all that particular metric which are a part of your prompt on the selected universe of stocks that you have selected. For example, in this particular case, I had selected Nifty 500, so it is going to compute a raw table for all the 500 stocks and the metrics that I have asked for in the time frame that I have mentioned in my prompt. Based on the raw data, then it goes on to put up the filters, which are again a part of your query or a prompt, and then it gives you the final list of stocks which are satisfying everything. So in this particular case, it gave me 30 stocks which are satisfying each and every criteria that has been mentioned over here. You don't have to drag and drop multiple filters, select multiple filters, just write what you want to view, and it will do that calculation and give you the output. The beauty of the platform is that we have also created a public library of multiple strategies, and you get to see whenever you run a particular query, you get to see whether the output stock is getting appeared in any of the other strategies or not. So for example, currently Hind Copper is getting featured in these 3 strategies. If you want to go and do a deep dive on individual strategies, just click on it and you get redirected into that particular strategy. Now, the moment we are running a live query, for example, this is the live prompt that I fed in and the output got generated. You can actually share and give it to your friends, peers, whoever want to make use of it, or you want to discuss it with someone. We are also having a early believers community where we keep discussing multiple strategies. So maybe Alok from my team can drop the WhatsApp group link on the chat. So whoever is interested, they can also come and become a part of our early believers group. We keep discussing these strategies over there. Now you can save this screen, you can name it, you can pick a category and save this, and eventually once the moment you save it, it goes inside the discovery module. Now discovery is the library of all the strategies that you can access on Tradl. There are public strategies which we have created. Each of the public strategies run during market live hours every 5 minutes. And during those 5 minutes, if a new stock is coming up, you get this particular stock featured as newly added. And during market hours, you can see which are the new stocks featuring, what are the hot stocks getting featured across multiple screens on Tradl. And if you want, in coming few weeks, we'll also be providing a subscription feature where you can subscribe to individual strategies, be it the public strategies or your own created strategies, and define at what frequency and at what condition you wish to get alerts or you want to get the notification that a stock is coming up. Apart from this, we have also created a module called Playground. So once your screen is created, be it a public screen or a private screen, you can simply click and add to Playground. Now in Playground, this becomes a dynamic watch list to you. You can create a static watch list, how you do on any other broking apps. And you can also pick a particular screen, which is either a public screen or your own created screen. For example, I've created those few screens from Anupreet's strategy. I can just simply click and that particular output table comes up here. If I want to customize these screens and make it more dynamic, I can actually do it because we give you a lot of flexibility in terms of what do you want to see here. Not just the list of stocks and their current price. You can combine technical numbers, fundamental numbers, and make this particular screen more dynamic in nature. Again, a key insight, you get to see live which are the screens where the stock is coming up. You can also convert it into a heat map. You can view the heat map based on one-day price change or weekly price change or how many screens they are featuring in and so on. So this becomes the dynamic watch list for you. You can just hit a refresh button and during market live hours, it will just keep on giving you the update. Also, we have come up with an AI news feed where all the news pieces can be seen here. Whenever you click on a particular news piece, it is going to give you an AI summary. It is going to tell you which are the tickers currently being affected by it and whether those tickers are getting featured in certain strategies or not. So this is something that we have built so far. The fundamental capability of Tradl is that it can perform any computation, be it simple or complex, for equity markets or quantitative strategies or retail investors doing swing trading, momentum trading. Currently, we have only exposed data for Nifty, the NSE stock universe, and the price currently integrated in our data pipeline is at a daily time frame. We also have the intraday pricing tick by tick to the minute level, and we also have the derivative data pipelines available. We are going to integrate it soon, so probably in the month of February you will see that you will be able to do any kind of strategy based screening or any kind of computational analysis, be it on derivatives, be it on an intraday time frame, or be it on a longer day time frame, which is a daily time frame, which is currently still available. So it will become more and more comprehensive, and in future we are going to come up with more tools, which is going to be a deep dive on individual stock research. You can break down news, you can do chart analysis using screens. We'll also be building a backtesting engine where you can just write prompts and Tradl will do the backtesting for you. You can do a visualization of all the outputs. You can do a sentiment analysis across social media, news, and the overall industry outlook, how the companies are publishing their own mandates. And by doing all of this, by individual tools, we will also be coming up with a workflow builder, which essentially is going to connect individual tools and perform an automated end-to-end execution for you. So for example, I can write down prompts in stock screening. I can then write my prompts in technical analysis to validate patterns on chart. Then I can backtest it, and then I can write my trade execution strategies by linking it with my broking account, and then it can handle my trades or investments at a certain desired frequency by my guided rules only. Okay, so this is not like a bot which is throwing up signals at you. This is a very thoughtful platform where you come up, curate strategies or access curated strategies, and in future convert strategies and actions into automated workflow. So the idea of Tradl is to build towards an autonomous trading future where we believe few years down the line people will not be placing trades on their own. There will be agents doing it for you, and this is what we are building at Tradl, and what you are currently seeing is just the foundation of it. So I'll just stop my presentation now and probably pick up questions if anyone wants to ask. Okay, so on the API interface, so currently we are not, we are very early stage, so we don't have an API interface as of now. It's more of a consumer-friendly front-end interface that you just saw. We want to serve retail traders, and we believe there is a huge gap between how retail traders operate in the market. Because there's a huge essence of human and emotional angles to your trading behaviors, where latency, lack of information, lack of speed also impacts how you perform, right? So currently API interface is not there, but in coming months you will be able to get that. Okay. Snehal, can I run query based on sectoral indices? Yes, currently we have all the NSE indices. So for example, you can select Nifty Auto, Nifty IT, Nifty FMCG, and you can run specific sector-based queries, and you can get this sector-specific strategy tested on your own. And the output will also be limited to that particular index that you have opted. So I've shown it. You can test it out on your own.
You don't even need to select any sector. You can just mention your sector. Like you can just say IT, automobile, any sector, and it will pick up the sector based on your prompt.
Yeah, that is also true. Okay, Samarth, you have raised your hand. Please unmute yourself. You can ask the question now.
Hi again. I want to ask, is there any AI strategy that you have used?
Yes, AI strategy in the sense, can you please elaborate?
Right now, whatever you explained, it is just NLP, like converting language into code.
Yes. It is.
And all the things that NLP, the code will do is statistical things.
Yes, I'll probably give you a quick example. For example, it's more, natural language here. So this is something that I tested last evening, only 7:15. I just wrote a very simple English, sentence framing my thoughts. So I was looking at stocks where the price level has crossed its daily 200 EMA within the last 14 trading sessions. The price crossover was complemented with a recent surge in the trading volume. Okay, I'm not even sure, because to be very honest, I'm not a quant trader, so I don't know how to name these terms. There might be, very specific quantitative terms behind these, or, keywords behind this, but I'm just writing it in a very plain English language. So I said 200 EMA ka price cross hua hona chahiye. There should be some surge in trading volume. Now filter the stocks where the price uptrend is still holding after the crossover happened, and now the next resistance in the price is at least 5% away, and within the last 7 days, in this week itself, there should be at least 3 bullish candle, which again guarantees recency in the momentum. So I wrote something like this. What it did was, again, it created a plan to detect 200 EMA crossover, volume surge confirmation, evaluate bullish candles in the time frame that you have mentioned, and also to find out the resistance gap. Then again generated the code, processed it on the raw data. Raw data, it was a selected universe. So I had selected all. So right now we have a coverage of about 900 stocks. So wherever it was able to find the crossover, it gave me date. Wherever it was not able to find a crossover event, it did not give me the date. And finally, these are the screened output. So right now we don't have the visual output available here. So you'll have to probably go and validate this on TradingView on your own, whether the crossover date was correct or not. However, this is something that I validated yesterday. This is fairly accurate. So you can test it on your own.
Sorry to interrupt. Actually, there are lots of loopholes in this. The first one, can you show me the prompt again?
Sure.
Let's just see the prompt.
Yep.
You are a new startup, and sorry, I don't know. Sorry to be critical at this point.
No, please feel be as brutal as you can. We are open for feedback only.
So the thing is, the crossover you can statistically confirm every time. It is fine. You said crossover. There is a point. Even if you put any TradingView indicator, it will show you crossover top notch every time. If you say, okay, crossover of this stock, it will show every time 100% crossover then and there. There is no doubt about it. But let's say you again ran this query, whatever API you use, ChatGPT or something, you wrote, okay, volume search. Okay, how volume search for how many days? First time it is always black box answer. It will never, it will tell you for how many days. Let's say for once, basically it, like volume prior to 20 days, volume by at least 30%. So it is like for how many days that the 30% took. Like for it just came in one day, it came in a period of 7 days, it came in a period of 12 days.
Understood.
So you can, so I don't know how you deal with this. Then
I'll let Shubham answer this.
Yeah.
Shubham, can you take this up?
Yes, you're absolutely right. So let's say when you write a prompt, so for example, you didn't mention, like in Nilesh example, Nilesh
even
didn't
let me complete the question, then you can answer it and all. Then you wrote 3 bullish candles.
Right.
So bullish candle can be just bullish, medium bullish, more bullish.
Yeah.
So every time you send the same query to ChatGPT or something, the backend API that you are using, so it's going to be a different case every time. I can guarantee you, unless you have particularly said, if the user says just bullish, you put it like, okay, this is 5% bullish, okay, 25%, at least 25% bullish. Or then what if the user says it is going to be very bullish or extremely bullish, that the candles above and top. So let's say the candle at the bottom is almost 99% and the candle goes up bullish. So there are, so bullish in itself is like a redundant thing. And
I'll just answer this, and I think this will answer all of your questions. So right now, how this has been designed is, it will, whatever parameters you have not put into your query. For example, you haven't put your trading volume, how many day volume average you want, what kind of bullish candle you want, anything like crossover or anything you want. It will do a best judgment on whatever, and it will do a best judgment on how the best trading practices are performed in market, and that is how we have trained it. But there is already a planning mode. So if you can run it on auto approve off, it will that is the reason we first show plan to you. So we'll show you plan, we'll show what assumptions we have taken. If you want, you can change any plan. Right now, so for Nilesh, who doesn't know quant, they will start with, let's say, okay, they have heard 3 bullish candle is required. In the plan, it will be written as, okay, 3 bullish candle. There you can just say, give me like a deep bullish or bearish, whatever you want. So the idea is you can control it. So we have an auto approve option there also for people like somebody who understands each and every parameter. But obviously there will be people who doesn't understand these parameters. So they want like whatever best trading practices are there in market, based on that, give me those suggestions. We are trying to, we have controlled it in a manner that if you write again and again, it will try to pick the same pattern based on what are the best trading practices. But you are free to mention, like in when Nilesh was explaining Tradl, you can write a very detailed prompt on what exactly do you want. The idea here is whenever you think of any thought of trading strategies, you require a lot of data pipelines to be built. You need to put in the code, you need to understand you need to get those data, verify those data, and then do any analysis. You don't have to do that. Any trading question is simply a mathematical calculation. You just need to know what are the parameters. I understand your query that the prompts may not be absolutely accurate, but that is true for any. You just need to, when you want a very good response from this Tradl, if you want a very good response, you need to give very good prompt, which covers all the parameters. If it is not covering all the parameters, you can always have an option to turn off auto approve, see the plan, change whatever you want to change in the plan, and then run the query.
So like still
so here I would want Nilesh, what he can do is, in the same plan, he can turn it auto approve off. It will stop for a moment when the plan is generated. There you will have an option of defining. It will first show you what assumption it has taken, and then you will always have an option to change.
I understand this. What you are trying to say, that human intervention at every point. So the thing is, like I have like lots of queries at this point. This.
For sure, we will.
If anybody else wants to ask, they can go ahead. I can move myself to the end.
Okay, what we can probably do is, Samat, maybe you can, if you have signed up using the form, we already have your number. We can connect with you offline, and we can take up a detailed discussion on this. Maybe, very happy to take up your questions and answer it in detail. Also, would love to, show you more capabilities on what we are building at Tradl. I would like to also open up the forum for the rest of the people if they have any other questions. Alok, is there any question from the chat I might have missed during the time I was sharing my screen? All right, cool. Samat, you wanted to ask something? Please.
Yeah. So, Shubham, this for you. This, whatever Nilesh explained, this is natural language processing. Just so your Quant, the Tradl AI, so it market itself as a Quant thing. So, is there any Quant AI strategy that you implemented? Apart from that, instead of it converts into statistical code and then run the statistical analysis. Is there directly AI thing that it is using?
No, so every trading right now, no LLM. If any LLM is promising you that it is giving you real time, the moment you allow your AI to see your number and make decision based on it, you are basically getting into the trap of hallucination and eventually will make it. This is
I just completed a master's in AI, so I know this.
I'm just explaining why this has been built this way. The reason we do not allow LLM to see any numbers, decide anything, do any reasoning. And the reason is very simple, that LLM, whenever you expose numbers to LLM will hallucinate. It will not pick up those many numbers. We will not be able to juggle with those numbers and be able to write anything. To answer any trading question, like be any trading question, forget about screening. If you just have any thought in your head, it requires calculation. What we are saying is, and it is beyond NLP. NLP will pick up the terms. You need to define your terms perfectly for NLP to pick up what do you want to express. Here, consider this is more like a lovable or any cursor, where you just write your thought. It has a context of what you're talking to, and then based on that, it determines what you need to calculate to answer your question. It isn't forcing any calculation on you. Whatever questions you have asked, it is just showing that it is coming out of calculation. No LLM is taking on the strategy. No LLM is not, and we are not planning to do that in future as well. We don't plan any AI to come into the picture of trade execution, trade planning. This is pre-planning, pre-building your strategy. Once your strategy is built, your decision making is done. It will continuously follow your advice and do autonomous trading. For example, like Anupreet mentioned, if you just built a momentum strategy here, refresh it every 5 minutes, you will, let's say if you want to take an intraday position, you refresh it every 5 minutes, you'll get a list of stock, invest it based on your criteria. You don't need to get into the maths of it. You don't need to get into the data pipelines of it. You just pick up a quant strategy, wrote it down with your thoughts. You put in your you can also include news. You can also include some of the market indicators, but it will not basically let LLM it will not basically let LLM decide anything. LLM is here to just calculate, to design your entire execution, but it will never get into your execution. And that is the fundamental of what we are trying to do.
Okay.
All right. Any questions for Anupreet on the quant front or the strategy front, or anything that we might have missed earlier while we were talking? I do see a couple of questions. I think Anupreet, maybe you can pick this up. This is an interesting. It has an overlap to how we would like to answer this and how you can answer this. So Anupam is asking, if a quant strategy works and gets widely adopted by, let's say 10,000 Tradl users at the same time, is it it's almost guaranteed to fail over time? Now, couple that with your future of agents, how we are thinking about it, that okay, agents are going to execute these tradings. So how will this work? So Anupreet, maybe you can first tell how this has evolved in terms of an institutional history point of view, because institutional strategies also become widely popular and eventually dilute in terms of their efficacies, right? And then Shubham can take it up in terms of how agents would be able to deal with this.
See, I mean, if you are imagining that we will get to an extent that it is so optimized that there is no inefficiencies in the market, then obviously nobody will make returns, and only return that you will get is a market return, right? And that's the reality, right? I mean, but it has not happened. At least, I mean, market is not that efficient. Even markets like US have some sort of inefficiencies, and people capitalize on that, right? So idea is, I mean, to figure out what are the inefficiencies on a regular basis, right? That is the whole idea of any quant firm or any investment firm as such, right? To find out these inefficiencies in the market and betting on it, right? I mean, if those bets are always returning in losses, and it is not limited to you, it is limited to market in general, then we have reached to a level that market are almost efficient, and it's almost impossible to beat the market in general, right? It will always mean revert to what market returns will give you in the long term. On the Tradl side, I'm not sure. Maybe Nilesh can add to this.
Yeah.
If somebody makes a strategy, is it public or it is limited?
No. So it has both the options. There are obviously, we are also building the social layer where you can make it public. But to answer this question more holistically, we see this future becoming a possibility. It was not a possibility a few years back, because not everybody understands quant, not everybody has access to quant. But now we see that in future, let's say not in 1 year or 2 years, let's say in the next 5 years, everyone's portfolio is run through an agent, which basically acts instantly to any market news. So for example, right now, any information that comes in, whatever time people take the benefit of those information, it is purely based on how people are reacting to an information. For example, hedge fund reacts fast to an information, quant fund reacts a little slower to that information, and then comes to the retail investors who reacts at the last of the any information that passes it. And that is the arbitrage that everybody is trying to make. So that this is not a clear arbitrage, this is an information arbitrage. This information arbitrage in 4 or 5 years will go away. Everyone's portfolio, everyone's trading book will be run through agents, be it somebody's agent will be running in-house on GPUs built on their system, and somebody's agent will be running through a platform like Tradl, or platform like where we will build a generic agent service for everyone and a marketplace for everyone, where you can just pick your persona and do a trading. But like Anupreet mentioned, market runs on inefficiencies. Currently, if there is no inefficiency in market, there is no alpha in market.
Yeah, I mean, sometimes even if, let's say, all the information is already, there in the price, still market will have certain sort of inefficiency.
Yeah,
I will
correct.
tell you why
And
this happens. There's a gold rally which happened, right?
correct.
Or maybe silver rally. Things like geopolitical risk, right? You can't predict it. It's impossible. You can't even think of modeling how any geopolitical risk, because you are seeing it for the first time, right? I mean, Trump, whatever he's
Correct.
doing, you're seeing it the first time. You can't model it, right? So if you are trying to reduce the risk, you are taking exposure into gold. All the central banks of the different countries are taking it. They can't risk in everything and buy gold upfront, right? They will buy in tranches. And if you see that pattern, right, it is again mimicking overreaction and reaction and that sort of thing. And prices go up and you take the position in that. It is sort of a very good momentum story if you see, right? So those kind of inefficiencies in the market structure itself will also have certain sort of opportunity.
There will be what we see, and this is where it becomes a little speculative. Here we are doing is, obviously this is speculation. Please don't get into that. Please don't quote us. We think how this is going to work is, in 4 or 5 years, everybody will have agents. Everybody will react faster to information. Everybody will be efficient. Everyone portfolios is grabbing whatever alpha is there, whatever alpha is available in market. And then, please, I hope there's no SEBI advisor or NSE advisor here, but then government will introduce instability into the market, or ineffective instability in market, because right now they have a lever of repo rate, which they use to make market more stable. And that is generating, and market itself has so many efficiency is so bad in market, or not, I won't say bad, there is imperfection in market, and which is why it is the entire trading ecosystem is working. How trading ecosystem evolves is a very interesting story that we are also hooked in. We are hoping to see how this is going to evolve, but it is not going to be like this what it is right now. It is going to change. Similarly, how it has changed the entire development space, coding space will emerge out to be trading space will emerge out to be very differently. And there will be market inefficiency pulled by some external levers. We don't know who it will be. It could be government, it could be some big institutions, it could be tech companies. But those inefficiency will make people to earn more money. These momentum strategies and all those strategies may or may not work. We will evolve to a more receptive system. We'll evolve to more agents acting real time, not like okay, I have done a planning for you, you run this on a frequency and then it is happening. It will run real time on your system, on your local devices where you have GPU installed. So a lot of hypothesis, but the idea here is, in 3 or 4 years you will not be rebalancing your portfolio. You'll not be looking into
just an interesting example, although not related to factors, but there was a very famous strategy that people used to capitalize on called as 920 straddle. Okay, so what they used to do, they used to sell straddle at 920 in the morning and square off the position by, let's say, 3 o'clock. Very simple thing to do. It used to make a lot of money for people. But what happened in 23, 24, there was a new player called Jane Street which entered in the market. Straddle is something when you're selling it, right? I mean, you are trying to be market neutral, right? So you're thinking that market will close in that range. If somebody is trying to manipulate the market due to whatever forces, your wall will spike. And once the wall spikes, you have to, take some decision, right? I mean, you will take stop losses or square it off, right? So इससे क्या हो रहा था, lot of people used to not understand what is happening, right? Market used to look good, सब सही चल रहा है, and then there is a, like, it was so fast if you go for a bathroom break and come back and see what happened, right? So, and it was happening every expiry, right? So these kind of things will always be there. There would be some player who are trying to manipulate some new information. They have money, they have information. So it's not like we don't have to worry about ki acha ye pura ekdam fully optimized ho gaya, there is no way to make money.
Market will figure out its own way of making
own
money.
way, right? I mean,
And it will always be a 0-1 sum game. So somebody will make money, somebody will lose. There will be agents efficient. The parameters will change. Right now, the game is somebody has quant ability, they will be able to make more money. Retail trader acts on information, or whoever has more skills in finding out patterns. Those individual skills or institutional skills will basically converge, and everyone will have similar kind of skills based on agents. But now the market inefficiency will change. This will introduce a new kind of inefficiency in market, whether it comes from a giants or whether it comes from government, it is up to, or whether it comes from a global pressure, but there will always be market inefficiency, and it will always be 0-1 game. Somebody will be winning, somebody will be losing.
Your job is to find, all these inefficiencies, like anybody who is trying to invest. Or if you don't have time, then you should trust people who are good enough to do this, right? I mean, there are two ways to do it, right? So you do it on your own, or you give it to someone who can do it.
All right, cool. Any more questions? I think we are, overstretched quite a bit. Samat, I think our team would reach out to you, will, speak at length to you. Separate.
One little thing. I just want to request, please clip me out if you are planning to post it somewhere. Is it possible to clip me out of the recording if you are planning to post it anywhere?
Oh, no, we are not going to post it anywhere, so don't worry about it.
Yeah, but if you do, please clip me out.
Yeah, sure.
Thank you so much.
Please, no worries. All right.
Just
any more
for you, just read to a paper. It's called time series is worth 64 words. From there, you will get the answers. It is just predicting the words. You can also use it in time series. Otherwise,
all right. Thank you so much for that reference. Any other questions? All right, cool. Thank you so much. Thank you, everyone. We hope you enjoyed the session.
Thank
we
you.
will share the details.
One last thing, all these strategies that I have told, it's just a work of our research. It doesn't guarantee any money. So be aware, whatever money is your money. If it is lost, it will not come back, right? So
important disclaimer.
Be very aware of such things, and believe in your thought process and invest very wisely. Okay.
All right. Thank you so much. Thank you, guys. We'll meet you soon in the next series. Thank you so much. Thanks, Anupreet. Thanks for taking our time. Bye-bye. Bye-bye, everyone.